Hey guys, welcome back to the channel, welcome back to a new video. Today we are going to look at the S&P 500 and then in particular the ES, so that's the future market of the S&P. Thought it would be nice for once to look at something else than Bitcoin, and also been a very long time ago. So if you like the content, please do me a favor, like, subscribe, click the bell, click on all so you don't miss anything. Leave me a comment, share this video with your friends if you think this is useful. Also feel free to follow me on Twitter and Instagram. Those links are in the description. Without further ado, let's start diving in. This is the future market, the ES, aka the S&P 500, on the 4-hour, pretty big time frame, and you can see that I drew in two boxes, and these boxes, they represent a gap in the chart, as you can see right here, and then of course we also have one right here, and that gap is caused by a change or a switch of contracts. And if I also press here on the purple balloon, then you can also see contract switch. And when there is a switch, sometimes there is a gap. You can kind of compare this between a opening and a closing gap on for instance stocks. Well, usually these gaps are getting filled, but it can take a very long time. There are also smaller gaps somewhere in the chart, but these are the two biggest ones, and I think actually that they are going to be filled. What we are seeing right here is the yearly high so far for the S&P 500, and we have been grinding a little bit lower, and now we came back up. And the nice thing about this is the moment when we came back up, we hit the golden pocket exactly, then we went lower, and now we are back at the golden pocket. Double top is not very uncommon for an asset like the S&P 500. We have seen them many times, the same for double bottoms. But if you are bearish and you want these gaps to be closed and the market to go lower, this actually is the moment to do so. Because if we are going higher, then actually I think we are going to take out the yearly highs, because there's not so much resistance above us. We had this wick right here, but that one has been taken out by this daily candle right here on the 1st of September. As you can see, we are right now trading just underneath the shoulder of the high, the second high. After that, there's only this high right here. Then we have a whole bunch of nothing. By the way, you can also see that there is also a small gap here. Nothing too big, but it is a gap, so it is worth mentioning. And actually after that, we just have the yearly high at 46.36. So if we are really going to push higher and we're going to take out this high, like I said, then there's only a little bit of a move to the upside for this high, and then actually I think we're just going to take out the yearly highs. Let's say we are going lower, then of course we first have this big gap here to the bottom, but then we could waterfall down pretty fast, because there is not too much underneath. First of all, of course, we have this low, but as you can see, then we have this sloping higher lows right here. This is usually filled by liquidity, meaning there are a lot of long positions underneath these lows, and traders are then long in the market, putting the stop loss there, and then we push price higher. That also means that if we eventually are going to waterfall down, that can go pretty fast. After that waterfall to the downside, yes, you have this wick right here, then you have this wick right here, and then you're already right away getting towards that gap. Well, it looks actually quite a lot here on the chart, but if I go back and then I just look at how much percent we're talking about, we are talking about quote unquote only 5%. Now I know 5% for the S&P 500 can be a lot, but if we take this in account in the bigger scheme of things, and we're looking at what the S&P 500 has done so far for the year, we're talking about 17.3%. That is really a lot. Matter of fact, the multi-year average, and I'm talking about the last 50 to 60 years, is an average of 10% return a year. So this is way above average. You might be saying now right away, well, Ray, didn't we last year had a minus of 20%? Yes, that is correct. But of course, there's still so much going on in the markets and with inflation that I think it wouldn't be all too crazy for us to push us down. Now, mind you, this trades very different than Bitcoin. There are complete different factors that move price, or that moves the S&P 500, the biggest index in the entire world. For example, the central bank, government sentiment, but also inflation. If inflation is rising, usually you see stock markets going down. If inflation is tempering or coming down, then you see stock markets rising, and then money rotates back into the stock market. Interesting enough though, in the last reading on July, we had a slight increase in inflation. We went from 3 to 3.2%. Tomorrow we have new CPI data, new inflation data. General consensus is that we are again going higher for the inflation, 3.6%. This could be a turning point. Now I have to say this 3.6% is a forecast. Most likely, or very likely, this has to do with food and energy, where the prices went up. That then increases the inflation, and therefore you see a little bit of an uptick. It doesn't have to mean right away this is it and now we are going back to 10% inflation, but usually inflation comes and goes with waves. So we could be at a turning point. If tomorrow is indeed 3.6 and a month after might be higher again, then we could really say, okay, then we had 3 months in a row where we see inflation coming up. Most likely we are going to see higher inflation again. Again, that will push the markets down, and then I'm first looking at this very big gap fill, approximately 5% from now. This could be one hell of a trade in case you are trading the stock markets. After that, we have this zigzag to the upside. This could get very messy and could be also a very profitable short if we are start losing the support underneath these levels, because this is nothing but liquidity, bad lows, grinds higher. It was yippee-ki-yay to the upside, I get it, but it was usually a fast move. So you have a low here, then there is no support here at all, then you have a low again, then you have a bad grind to the upside, just like the one that we have now, and then we have these lows, then again you have a grind to the upside, then you have lows here. So actually I think depending on how we reach this level, and that box ends at 4,300, let's say 4,302 to be precise, 4,302. Depending on how we reach that level, if we do not spend any time here, or maybe just one day and then we break it, I think we are going to take out this major part of liquidity of the market, and then we're talking about an extra dump. Let me check right away how much that is. We're talking then about 10%. Is really a lot, and then we need to see really some really bad news coming in. But even if that would happen, a minus of 10%, mind you, you still have a positive of plus 7% for the year, slightly under the multi-year average. So that actually would be a super nice short scenario. Usually when I'm trading this, I'm taking this day by day, level by level, but sometimes it is important to zoom out to look at, okay, where are we now? Is there, if we just look at the chart, are there reasons for us to go lower? And if we zoom out and we're looking at what are the drivers, so again inflation, can we have triggers from the outside, in this case inflation, central bank, whatever, that could be a spark, a trigger to eventually let the markets crash to the downside. This is now for me the main scenario in the next couple of weeks that I think this actually really could play out. We are at the golden pocket. We might be making here a double high. Inflation might come back up again. So all these indicators and ingredients could be a very nice indication that we are going lower. Like I said, if that doesn't happen, if inflation stays pretty okay, or maybe even comes down again, then I think we are going to shoot up, and we're going to take out the yearly highs at 4,635. Quickly then look at the indicators, because if we're looking on the daily, then we're seeing actually that the money flow is already flowing out of the market for a pretty long time. So this looks bearish. If we then have 1 or 2 sideways days, you will see that also the momentum indicator will print a red dot again, and then you're just rolling over. This will then be a trigger wave. That is pretty bearish. So trigger waves are usually these smaller waves and not these very big waves on top. If you have then a trigger wave, red dot, RSIs may be coming together, view pointing down, and money flow flowing out, I think that this actually for the next couple of weeks or months can be a very valid scenario. Let me quickly look at the 2-day, because I think it is not much better. No, it's actually, for the money flow, it's a little bit sideways, but this could still roll over. That just needs a little bit of time. On the weekly though, we do have a green dot, but money flow looks like it wants to roll over, and also the VWAP is inward curve. Usually that is a sign of weakness. You would say, hey, the VWAP is going up, that is great, but this actually could be a sign of weakness, that it once it rolls over it goes pretty fast, and the same then goes for the money flow, and then you have a very big hump of money flow and a much smaller one. That is a double bearish scenario, because then the new buyers or the new bulls stepping in cannot push extra money flow into the market for price to go higher. So then you have really a huge hump and then a much smaller hump, and then also triggered by a inward curve VWAP. This actually could be on a very macro scale, so I'm really talking about weeks ahead, actually pretty bearish. So then you could see maybe a move to the downside in the next couple weeks. Let's quickly zoom in then on the 12 hour. Here we already see actually that we are losing some strength here. This actually doesn't look all too good, let's be honest. RSIs are split, VWAP is down, momentum wave looks like it wants to make a lower high. So yeah, this actually just looks pretty bearish. And on the 4 hour and on the 4 hour and the hourly, that can change every day. So this is right now what I'm looking at. I'm staying very cautious. Breaking the current level could happen with CPI. I'm aiming for new yearly highs. If that doesn't happen, then eventually I am first looking at this bigger box to the downside, 4,302, and eventually if we break that to maybe at the end of the year, approximately 4,000 and let's say 55. That will be it for now, guys. If you like the content, please do me a favor, like, subscribe, click on the bell, click on all so you don't miss anything. Leave me a comment, share this video with your friends if you think this is useful. Also feel free to follow me on Twitter and Instagram. Those links are also in the description. See you guys very soon again in the next one. Bye bye.